Hey everyone, welcome to the show. This afternoon, we are here for a one-on-one conversation with Gunjan Banerji. Gunjan is the lead writer for Markets Live at the Wall Street Journal, also a CNBC contributor, certainly a familiar face to many of you here at Public. Gunjan, appreciate you being here. Thanks a lot.
Thanks for having me. I'm excited.
So we are 1 week and 1 day removed from the Fed lowering interest rates, not by 25 basis points, as many had been expected, but a jumbo interest rate cut. What have you seen, Gunjan, in the markets since last Wednesday's announcement? And I wonder, any surprises to you in the last 7 days or so?
I know what a move by the Fed. They really kicked things off in a really bold way. And what I've been seeing in flows and positioning and hearing from investors is that this jumbo Fed rate cut really turbocharged enthusiasm among many investors for stocks, right? I think it kicked the soft landing trade that has been in action for much of this year into high gear. We saw the S&P 500 hit a record. We're seeing high yield bond spreads fall to levels not seen since 2022. Measures of volatility have fallen. So it seems like people are really piling into this market now.
The S&P 500 is up about 20% or so year to date. And right now where it's at, it's already above the updated year-end targets from names from a lot of the big brokerages on Wall Street like Goldman, UBS, and Wells Fargo. Do you see us right now that we're beating expectations? We're due for another pullback, the likes of which we've had a few of already, or something else going on altogether?
It's so interesting because we are seeing volatility come down at a time that's typically rocky for markets, right? September, October tend to be some of the most tumultuous times of the year for the S&P 500, but you're actually seeing the opposite thing play out, where you're seeing volatility come down and you're seeing stocks kind of keep rising to new highs. And investors I've been chatting with said that they do expect this run to continue. All of a sudden, my inbox has been hit by people raising their targets for the year, saying they expect it to continue through year end. So it's going to be a really interesting next couple months for markets for sure.
It's always a funny exercise to go back and look at last December's year-end targets and then look at those kind of quarterly updates throughout the year, and we've continued to push through them. So it's always worth, I think, at the end of a quarter, kind of revisiting some of those targets. So I appreciate that last note. Gunjan, you wrote this week, people are growing more and more bullish. How do you see investors better positioning themselves for this rally to continue, hopefully, into Q4?
I mean, it's really interesting. We have seen, some of the S&P 500's most cyclical stocks and sectors really on a tear. I mean, think about the stocks that have hit new records this week. Stocks like Caterpillar, right? That's a bellwether stock for the economy. Stocks like McDonald's. So these companies are kind of flashing green right now, and people are piling into this market. I think one of the most surprising things to me has been since the Fed cut interest rates, we've actually seen flows into money market funds. And I think that's something that not a lot of people were expecting, right? I think the prevailing market wisdom for a lot of this year was that as the Fed gears up to cut interest rates, we are going to see this torrent of cash piling out of money market funds. And instead, the opposite has happened.
What would your expectation be for that to continue if we get maybe one more rate cut between now and the end? Maybe even if there's a pause the week of the election and the Fed continues with cuts in December, you expect that movement into money market funds to continue?
People I've been talking to have been saying yes. And I came across a really shocking statistic, which is that institutional money market fund assets typically increase by around 3% in months in which the Fed is trimming interest rates. So I think that's just really the opposite to what a lot of people expect will happen when the Fed starts trimming interest rates. And I think part of this is unease about some of these big gains that we've seen, right? Going back to what you were saying, people are getting more bullish. Where were people's targets relative to where they are now? Have things gotten a little out of hand? I think we're seeing that in the money market fund space a little bit, and of course, assets like gold. So while you have the S&P 500 just totally on a tear, you have people still piling into these safer bets like money market funds and metals.
Gunjan, I know you read a lot about volatility. The VIX is down, at least at a lower level where it's been. It's around 15 and change. Back on August 8th or August 5th, rather, it spiked all the way up to 38. Kind of what do you make of kind of the VIX movement we've seen? I mean, it seemed like such a different narrative driving things during that early August sell-off. And I think you probably see that reflected in movement in the VIX, right?
what a wild ride. I mean, that was crazy. That was crazy to see it jump to 65 in overnight trading, and then a week later we're back to normal. The S&P 500 is, up again, little change from the prior week. It's been a really, really crazy ride, I think, particularly for volatility. Um, Investors I was talking to throughout August and even September were still like scratching their heads, like, what happened there? Where we just saw such a big jump in volatility, and it just seemed like an outsized move relative to some of the fundamental fears about the economy and what was going on in the broader markets. But I think this has been a tough market to bet against. People placing bets that volatility will rise or stay higher have been on the losing side of things, and I think that helps explain why things snapped back so quickly. Right, like just like that, you saw the VIX back down. Again, just this week, it hit the lowest level of the month. People started piling into that really popular trade to short vol once again, and yeah, we were back. We were back at highs.
Yeah, the bear's going back into hibernation, as our good friend Dan Ives at Wedbush Securities likes to say. So, given all the optimism here for investors, Gunjan, and you've done a great job sort of laying out that case, we do have certain assets that might be typically positioned as a bit more of a hedge, a bit more defensive, something like gold. Gold is basically or right near an all-time high. What do you make of some of that movement, despite the anecdotal optimism that we have in all these other data points?
Yeah, look, I mean, the gold move is in part because of interest rates, but at the same time, you make a really good point. Some of this is showing some of the anxiety out there, right? With the S&P 500 at an all-time high, it's up almost 20% for the year, or right around 20% for the year. That would put us on track for 2 straight years of double-digit returns. I think some people are saying, hey, with interest rates falling, but still not super low, right? Like maybe a money market fund yielding around 4 or 5% is still really good. It's still a good place for you to park some cash. Maybe this is time to take some money off the sidelines and put it into traditionally safer assets like gold. So I think that shows you that there is a little bit of fear out there, even though we are at all-time highs in the stock market.
We're always tracking trends among younger Americans, younger investors in particular. And according to some new data from Bespoke Investments, Americans under 40, Gunjan, they got about 20% right now of all their assets in cash. That's more than any other age group. What do you make of that type of trend? And I wonder if you expect a type of rotation into other assets among younger Americans as the easing cycle from the Fed continues.
I think that stat is so fascinating, and I think people's views on cash have changed the past few years. In before the pandemic, what I would hear from most investors, and particularly younger investors, is that they were stashing away every single dollar of their portfolio into the stock market. And things like fractional investing made that a lot easier, right? You did not need to leave any money in your portfolio in cash. You could put every dollar, every penny into Tesla, Apple, the S&P 500, you name it, and that's what people did. When interest rates were zero, there was just no reason to keep money in cash or money market funds because the risk of missing out on a big rally and those higher returns was just too high. And now all of a sudden you have a competing asset, right? I think that the past few years, that's what we've seen, whether it's things like COVID, which reminded people of the tremendous volatility that can hit their portfolios, or these years of now higher interest rates that we've had. People have been reminded that cash has a position in your portfolio. This is why sometimes you keep a little bit of money on the sidelines in case something happens.
So since you mentioned 2020, I couldn't help but have these flashbacks to like the meme coin craze and investors, especially retail investors, piling into crypto assets, even if at times not maybe having a full understanding to them. And I feel like we've revisited that conversation the last year or so, but only briefly from time to time. It's like whenever we have that little bit of a spike in the AMC's or GameStops of the world. Do you still see that being a big part of the conversation? That this idea of these retail investors years ago looking for alternative investments, some creative investments, and latching on to some of those type of assets?
Look, I think the meme stocks are old news, right? Like that craze has fizzled, but it's also evolved. And I don't think that the risk taking that you're talking about has gone away. Just like we've seen a different attitude towards cash, interestingly enough, I think we've also seen on the other side, the very other side of the spectrum, a really different attitude toward taking risks in the market. People are not shying away from, speculative stock investments, from meme coins, from gambling in the stock market. And I think things like leveraged exchange traded products really personify that, where often those are the most popular ETFs traded by individual investors on any given day, is things like, you know, an ETF giving you turbocharged exposure to a semiconductors index or a single stock Tesla ETF. So people are really hungry to double down in certain corners of the market. And I think that's in part because of a shift that came about during the COVID-19 pandemic.
Well, speaking of double down, if there's a stock a lot of people have liked to or wanted to double down the last couple of years, it's certainly Nvidia. It's been a wild ride. It has recovered a fair bit after slipping in earnings back at the end of August, but still off its all-time highs. How dependent do you think is the broader rally, this ongoing rally and optimism that you're talking about, contingent to ongoing chip stock success? And I guess another way to phrase it is, are we seeing sufficient enough rotation for those big consolidated tech names like Nvidia to not do as much of the heavy lifting any longer?
So these stocks are super important to the market just in terms of their sheer weighting. They are really important. Think on just a single day in September, right? Nvidia's turnaround after a Goldman Sachs conference when its CEO made some really bullish comments on demand. Nvidia started to turn around, and so did the broader S&P 500. That being said, I think when you zoom out, we have seen this market rally broaden out. We have seen other corners of the market pick up some slack. And after NVIDIA's last earnings results, for example, the stock did fall, did do so well. Expectations were crazy high and they weren't able to meet them. And yet the market did kind of inch up after that. So I think the rally can go on without NVIDIA. We've seen the equal weighted S&P 500 ETF hit new highs recently, which tells you that other corners of the market are leading the way.
Gunjan, if this rally is going to continue, what are some of the key things you think that need to happen? Or are there major headwinds you think that could derail progress of this rally as we continue on this year?
It feels like we're in a little bit of a fragile point here where it feels like investors are so hooked on every single morsel of data that's coming out on the economy, right? Like ever since those growth fears started to perk up in August, I feel like the inflation data has kind of taken a back seat, and now it's all about economic growth and the jobs data. And I think we saw that this morning, where it turns out the economy has actually been stronger than a lot of people thought, with some revisions to the prior data. Jobless claims less than expected, and that's all reinforcing this soft landing trade that's been prevailing since the Fed's rate cut last week. So I think that economic data is so key to watch. I mean, next Friday we have the jobs report. It feels like a lot of people are resigned to the fact that inflation is falling, and now it's really a matter of, is the economy about to fall apart, which I think has made a lot of people nervous in recent sessions.
Yeah, especially with the Fed essentially admitting here they've started to underemphasize the pricing side of their dual mandate and begun much more to focus on the deteriorating conditions in the labor market. So I think that jobs data is really important, and obviously subsequent Fed meetings as well. Before I let you go, as of today, we are 40 days out from the election in November. I'm sure you've heard there's an election coming up. You think Wall Street right now is, for the most part, in a wait and see a moment? Are we kind of shrugging it off altogether? We just kind of don't worry too much one way or another until the dust settles? How do you see this playing out?
Look, there's often volatility around an election. In the derivatives market, you can see right now people are paying up more for contracts that would pay out if we saw a decent amount of turbulence heading into the election and right after the election. So there's this kind of kink in the VIX futures curve around October, November. That being said, I think for individual investors sitting out there at home and taking a look at their portfolios, in BlackRock data going back to 1928, we can see that though the path of stocks differs in election years versus non-election years, on average, they head in the same direction. And going back to 1928, the average annualized return on the S&P 500 is around 7 or 8%, regardless of whether we're in a year where there's an election or not an election. So I think that's just, one thing for investors to keep in mind, especially if things do get really rocky around the election. That does typically happen. We tend to see some waves ahead of the contest.
Yeah, absolutely. It's a fascinating conversation. Really grateful for your time. That's Gunjan Banerji, the lead writer for Markets Live at the Wall Street Journal, also a CNBC contributor. Gunjan, thanks a lot.